Why did the Federal Reserve, the backbone of our economy, slash its projected rate cuts from 4 to 2 for the year 2025? And what does this mean for the market and your investments? The Federal Reserve's recent actions have sent ripples of uncertainty through the market. The sudden shift in stance from accommodative to hawkish has left investors and analysts perplexed. This turn of events is all the more surprising given the signs of looming economic weakness. The labor market, for instance, seems to be showing signs of strain. Major retailers like Big Lots have announced the closure of nearly 1,000 stores, leading to an inevitable wave of layoffs. Research from the Philadelphia Federal Reserve suggests that the job losses began as early as the second quarter of 2024. This is a stark contrast to the Fed's optimistic projections. On the other hand, inflation, the invisible thief that chips away at your purchasing power, is expected to slow down. Research from the Cleveland Federal Reserve suggests that shelter inflation, a significant component of the Consumer Price Index, could decline from 4.6% to approximately 2% by the end of 2025. This moderation in inflation is further reinforced by the fall in auto prices and a slowdown in consumer spending outside the luxury sector. Economist Danielle DiMartino Booth believes that we may have already entered the early stages of a recession in 2024, and it's likely that official recognition will follow. She expects the recession could end by mid-2025, though it's important to note that job losses typically continue even after a recession technically ends. So what does this mean for your investment strategy in 2025? DiMartino Booth suggests focusing on dividend-paying stocks with secure payouts, gold, a traditional safe haven in volatile times, and bonds with reliable income streams. In essence, maintaining a defensive positioning while focusing on cash flow generation could be the key. There's also a cloud of uncertainty hovering over the housing market. The growing inventory of both existing and new homes might put downward pressure on prices as financing becomes more constrained. In summary, the Federal Reserve's recent actions have introduced a level of complexity and uncertainty into the market. The labor market is showing signs of weakness, inflation is set to moderate, and there are indications that a recession may have begun. This calls for a strategic and thoughtful approach to investing in 2025, focusing on secure payouts, gold, and bonds with reliable income streams. The housing market, too, warrants close attention as increasing inventory could lead to a drop in prices. As we navigate these uncertain waters, staying informed and adaptable will be key to maintaining financial stability.